Welcome to the Seattle Angel Conference round 26 workshop, pre-event workshop series. Today we're going to talk about how to ask investor questions with our lovely Yoko Okano, who has been all possible roles inside SAC. Yoko, tell us more.
Awesome. So thank you so much, John, for having me, and John and Kristan. Excited to kind of be back in the SAC world. As John said, I did probably I think I participated in 5 rounds of Seattle Angel Conference as an investor a few times. And then, as he said, I was an assistant for 13, and then ran SAC 14, and then sponsored a couple of spots as well. So it was really a key part of sort of the beginning of my angel journey. For myself, I started angel investing because my husband, my partner, happened to have opportunity to invest in a company of one of his friends. And so he said, hey, I'm going to write this check into this company. And I was like, why? And, how? And what is this? Why are we making this decision? And that was kind of the start of it. He sort of opened the doors and opened my eyes to this asset class and sort of the opportunity there. And so initially we started investing. We invested in that company, and then we invested in another company that was run by a colleague of mine coming out of Google. And then there's this piece that starts going like, I'm worried that my network, as amazing as it is, won't keep producing in the same way. And I feel like there should be more structure and thinking to this process. And that's really when I happened to run into Seattle Angel Conference through Elaine Orfley, who's been part of the Seattle Angel Conference community for some time now. And she really opened my eyes to the opportunity of the conference. And I think for SAC, I really enjoyed this idea of coming together with a group of folks who I may not have connected with just in the tech community, and really understanding what questions people are asking that I should probably be asking, and then also the questions that people are asking that are less relevant or less interesting to me. This is part of the process that John will start to poke at around, like, what is your thesis? And whatnot. So, I think it's a really great place to start to build a little bit more of an opinion on the way that you want to build your portfolio. So today I will find my slides here. Today I would love to walk you through some slides just on asking good questions of a deal. So one of the great things that through the beginning of the SAC, what you'll get is you'll be thrown into a world of looking at 60 plus pitches. John, you said 64.
Yeah, we've got 64 in the queue at the moment.
Awesome. So at least 64 decks. And that's like a lot to dive into. And then you'll do a process where you actually have to whittle that down very quickly as a group. And then you'll have the opportunity to meet with founders in sort of 2 chunks. And when you're listening to a pitch and you're sort of asking questions, you really want to get to the most relevant questions or the most important questions first, because as an angel, your time is always a little bit limited. Right. And so I think that's really the intention here. And we're really lucky. I asked Matt, John connected me to Matt, and he was willing to be, I would say, like live ammo for us to actually react to. So we will have him do a very short pitch. Again, it's, I would say this is a little bit not super representative of like the actual angel experience, and that you would probably be doing like a coffee meeting that's at least 30 minutes to get to know Matt and sort of the opportunity. But in this sort of strange little kind of world, we'll listen to a 5-minute pitch, and then I won't even do Q&A today, which is unfortunate because I know Matt probably has a lot to add here, but we're really kind of going on, if this is all you heard, how do you then form an opinion and start to formulate the questions that again, in this weird simulated situation where you look at a 5-minute pitch and then now you have a coffee meeting, then you can sort of say, like, here's the areas that I want to cover. So that's intention here. I will share my slides. Share. And we'll start with a little bit of at least context too on who we are. So, as John mentioned, since Seattle Angel Conference, I have gone on to start First Row Partners. My business partner and I both have our roots in Seattle Angel Conference. So it's a program that's near and dear to us. But today, as a venture firm, we are structured as a very traditional fund firm, right? Like it's central decision making between myself and Minda. It's not sort of an angel fund in our structure. So we have gone kind of into a different, I would say, like area in terms of how we invest. But a lot of the things that we invest in, it really comes from the hallmarks of like what we invested in as angels and where we worked as operators. So a lot of what we're looking for is where software and technology really provides superpowers to the people who are building and teaching and sort of making in today's world. So we have about 22 companies in our portfolio across a couple of funds, and you can see some of the snapshot of the portfolio there. And if there's ever, I would say like separate from this conversation today, as you get going with Seattle Angel Conference, if there's an interest to explore the VC side of things, I'm always happy to share sort of Minda and my learnings from like starting Fund 1 in 2020 and kind of getting going there. So feel free to reach out. So, to give you a snapshot of, again, who we are, Minda and I really are two sides of the coin. Minda got into angel investing because she was coming out of the operating world as sort of a, multi-time founder. And, she had deep operational experience. And I had, by the time I started First Row, we have, I would say actually about 50 investments, a handful of them through Seattle Angel Conference. And we both, as Shannon said, it's always nice to see students post program. But Minda and I teach at the University of Washington. Funny enough, with her entrepreneurial background, she would be maybe a more natural side of teaching for the Master's of Science in Entrepreneurship program, but I teach in the Master's of Science in Entrepreneurship program, and she teaches angel investing. And I always think about it as like that is pretty reflective of who we are, right? Whenever we see something that feels like I need to go learn that, like that's what we become experts in. So we've both sort of filled in the gaps and found ourselves teaching to learn and learning to teach, right? So it's I would say like the type of work that we're doing now is also consistent with the way we approach our work. As you know, with all of this space, this is not investment advice. I'm going to share a little bit about how I approach and how we at First Row approach investments and all this stuff. But again, just the typical disclaimers of like, you should, this is really just showing one way to do it. It is not sort of the end all be all. This is another data point in your learning process. All righty. So we will talk a little bit about the fundamentals of identifying a great deal. We'll then listen to a pitch, and then we'll kind of have a little bit more of like a discussion / kind of live session on getting to the most relevant questions. And as we're going, I'm also going to open the chat too. So if there's things that I am that we should revisit, please do add your questions in the chat so I can keep an eye on that. Okay, cool. All righty. So if you've been around John Seacrest and the Seattle Angel Conference workshops in some way, you should probably know that startup investing is a great way, and it's a fun way, shall we say, to really build a diversified, well-run portfolio, but it is high risk, right? And so you really want to think about your allocations to asset class appropriately. And then there's really different ways to achieve diversification. And so John, and I'm sure you'll hear Christiane talk about trying to get to that minimum of 20 companies. And I think thinking about the math of how you get there is a really important part of it. So with those two things, kind of foundational things in mind, I'm really talking about sort of the diversification within, right? How do I know what I'm looking at? When I'm looking at a deal, what's really important? I love thinking about when you hear an entrepreneur pitch or when you look at a pitch deck, right? You should think about it as if you are this person on the left, blindfolded, and you cannot see this amazing, beautiful, like abstract art piece that the founder has painted. And they can see it super clearly, and you are literally like, you cannot see it. And so if you think about like what the founder is trying to do is explain to you, like they might be trying to give you a system for understanding and making sense of this piece you cannot see. So I think for investors, it's really important to hold this framework or this sort of visual in your mind, because it can be really easy to just be like, well, I just don't get it. Right, you don't get it, but the founder has clearly, like, what can we do to help them tell their story better? How can we try to understand what's going on a little bit more too? And what you'll find through the Seattle Angel Conference experience is that you might ask John and Christine for a checklist. What are the things that all of these companies should have? You will not get a checklist. There is no checklist. And it is also very subjective. This is why John is pushing on the idea of your thesis. What is your individual impact sort of goals with this asset class? And so often when I'm making these investment decisions, I explain this to companies, I have a specific box I've drawn around myself. And in this particular case, that's the box with which I use to raise capital, right? And so for you, that box is, again, your very personal, subjective one. And some of those check boxes for a lot of angels, especially in the venture scale category, might be like, is this a type of stage or ownership percentage that I want? Can I expect a liquid exit of at least 10x in 6 to 8 years? I would say 6 to 8 years is short in this case. I would probably look at like 8 to maybe 15 years. So again, long time horizon. And then I think really most importantly for us, what we often think about is like, is it spring loaded? So you'll hear John talk about the idea of like, companies are sort of these little toads jumping across lily pads across a pond, right? And so you really want to see that the capital that they're raising is sort of loading up the spring and allowing you to hop to the next lily pad, not too far, but not too short, right? And so you're trying to understand, is the team spring loaded to make progress? Is the product kind of just there where it's about to spring out? And so you're always thinking about the funding from in terms of sort of these like inflection points and milestones. And this last question, I would say, like, again, wildly successful. Everyone has their own definition of it. It might be the liquid exit, but if you're an impact investor, there might be other aspects to that. But do I really believe that they could get there? And I think it's also really important as you look at these companies to understand that, like, the type of business, and especially the first week, you're going to be looking at 64 companies, right? 64 plus. There's going to be some companies in there where the maybe venture capital or angel capital is not the right solution for them. And so it's, I'll walk you through a few examples of how to kind of look at those measures. So for brands and CPG, let's say you're making a new soup. You have a new brand of canned soup. Great. Talking first about green, like market size is green because a lot of people like soup. So, there's a lot of types of people who like soup. And there's a lot of places, the distribution opportunity, there's a lot of places you could sell soup, right? And then in the yellow here, of course, there's a little bit of a question around, like, how often do people buy soup? How many cans? You can't really have some scalability around, like, I can really probably only have max 3 cans of soup a day, right? So there's a little bit of this sort of like scalability question. And then is there seasonality in that? And then I would say in yellow, there's also the exit potential. The exit potential for brands and CPGs tends to be a little bit lower than, say, the SaaS, which we'll talk about next. And then I think in red here for brands and CPG, you have to make soup to sell soup. So that's in red, right? You kind of need to front load a little bit of sort of investment in order to even create the thing you're building. Limited patent protection here, right? Can of soup, it's pretty hard to patent. And then again, the conditions to scale. Every time it's like there's a limited amount that you can sort of work on the margins of the business, right? There's always going to be some cost going into building the thing. And so when you think about brands and CPG, lift-off capital sources, there's a few of these options, right? Whether it's customer revenue, right? This is why I would say some brands, physical goods products might start with something like a Kickstarter. I don't know that that is necessarily the best option, but getting people to pay you to make the thing, that's an option for brands and CPG. Angel, maybe you find somebody who loves soup. It's a very personal side of things. So I think those are sources of lift-off capital. I think venture capital is in yellow here because I would say brands and CPG, it's because of those conditions to scale, the exit potential, they're less, I would say, sexy within the VC space right now. So it's a little bit more in the yellow. So this isn't, now if you look at enterprise SaaS, right, a lot of, especially here in town in Seattle, you see a lot of folks who fund enterprise SaaS. Now, why might that be, right? A lot more green in the considerations here, right? Patent protection is still not super, I would say, like relevant, especially for software, but a lot of things in green, especially around revenue scalability, right? And the conditions to scale and potential for exit. And so that's why venture capital and angel becomes more appropriate for this type of business. So I would also, I think venture capital and angel investment is really what often companies find most information about when they're sort of like, hey, I feel like I want to grow and I'm not, I need some capital to get me off the ground. And so they sort of like, oh, I found this resource from YC Startup School about how to raise venture capital. So I think I'm going to run there. But they're not really thinking about this middle part of, does my company have the right, like, sort of characteristics for the capital source? And are there other ones I haven't explored? So it's important, I think, as an angel to understand, what are the other places that this company could be going that might be more appropriate for that business. And we're rushing through a lot of this stuff where each of these slides and these sections could probably be a whole workshop, but I kind of want you to have a little bit of a background foundation so that we can sort of move from there. Again, this is not intended to be exhaustive. It's just a really quick overview. I think valuation is, especially at the stages we're looking at, you're going to see a wide range of valuations, right? There's no set rule. It is much more art than spreadsheet at this stage. Individual angels, I would say, on one hand, like, it's good to know about it, but like, you as an individual are likely not setting terms. Perhaps, Kristan, as the lead organizer for this syndicate, may have some say in this, but it's not super typical that individuals have some say in the terms, but it's always good to know. And if you want to kind of dive into the ins and outs of what happens with a particular deal term and whatnot, venture deals is a great way to get really, really nerdy. It's also really important to have some fluency with some of the words listed here, whether it's like, is it a convertible note? Is it a safe or a simple agreement for future equity? Or is it a price round? As an angel, you'll probably not be seeing that many price rounds, especially in Seattle. Most of the deals these days are done under safes or convertible notes. And then you might have some basic understanding of sort of like the deal terms, right? What's the difference between pre and post valuation? What does it mean to have a discount and all that stuff? So I think I have this here more as a reference point, come back to these slides and then like kind of figure out like, oh, I actually don't know that. Let me go read up on it. And then one of the last things I'll say here before we kind of shift into really evaluating the deal is expect to say no a lot. Well, with Seattle Angel Conference, you're going to look at 64 deals and you invest in one company, right? Maybe a couple if you end up doing some of the sidecars. So that's a pretty low yes percentage, right? And I think as an angel, it's really important to just remember that it's like the default answer is no, right? And you want to be thoughtful about the feedback that you offer. You want to make sure you don't waste founders' time. And you also want to think long term. Find those founders that you're like, I actually want to mentor you, even though I don't want to invest. And what are the signals that you'd be looking for if you wanted to take that step? So a really quick race through of some foundational concepts. Again, we can revisit some of these if helpful, but we're kind of going to listen to a pitch, and we're going to do a couple activities related to this. So we're going to listen to Matt's pitch. It won't be 5-7 minutes. I will probably, I've warned Matt, but I will probably, if his pitch goes much longer than 7, I'll actually cut him off, just so that we can keep moving, because this is really, again, just for us to get some fluency around like what a pitch sounds like. And I want you to jot down, what are the data points that feel most relevant to you? What observations do you have about the founder? Like, does Matt use his hands a lot? I don't know. And what are the also, and then as we're kind of listening, think about like, how would you describe this company? And then what's like, if we were to go into Q&A, what's that first question you ask? And so that's kind of the background I'll give as you're going to listen to the pitch. Does that make sense? Any questions before we jump in?
I don't see any hands up and no thoughts in the chat.
Awesome. Great. So I will stop my share, and then Matt, the floor is yours until I say it's not.
Until you kick me out. That's fine. Awesome. Well, thanks so much, Yoko and John, for giving me the opportunity to share a little bit about Birdhouse with you all. Just as a reminder, at Birdhouse, we're reimagining childcare with a tech-enabled micro center model that operates out of residential homes. So first off, I wanted to share a little bit of background about myself and my co-founder. So my co-founder, Sydney, and I worked together for over a year.
Matt, one quick second. Are you sharing slides?
No, I
Okay.
prefer not to share slides.
Okay.
Cool. Yeah, so my co-founder, Sydney, and I worked together for over a year as executives at The Village, which is an EU startup that operated a franchise network of over 100 micro schools. I was COO there, and Sydney was VP of marketing. And Sydney and I were both drawn to the space through a similar lens, which was our actual families. So both of my parents, as well as Sydney's mom, have spent their entire careers in early education. And we were able to witness firsthand how childcare and early education really fails both families, but also educators. And we were really passionate about the space, and we wanted to take our experience from The Village and bring it back to the US and address the childcare crisis here. So what is a childcare crisis? Many of you may have heard about it on the news or even heard about it in presidential debates that have happened recently. But overall, there are more dual working families now than ever before. Parents really need quality childcare options. It's a massive market. It's a $65 billion market alone in the US, about $250 billion globally. But although the market is huge, it's super fragmented. So over 80% of the market is only mom and pop centers. And of those centers, 70% of those centers experience excess demand. Now, what are the major problems with that, or why? What is causing that? And there's really it really boils down to two major problems: access and quality. So on the access side, currently 51% of millennial families live in what's classified as a childcare desert. And COVID really exacerbated this, which forced 70,000 centers to close. And of the existing options, not all of them are quality either. So families have limited before and after hours care. There's a huge lack of consistency and generally chaotic and uninspiring centers. As we dug into the space, we really began to find the underlying realities that hold the sector back. A lot of this is actually due to limited commercial real estate availability that keeps large commercial providers like a Bright Horizons or KinderCare out of these areas. And the specific areas that I'm talking about are very parent-dense neighborhoods like a Magnolia or West Seattle. these areas are the areas that face a tremendous lack of supply due to lack of commercial real estate availability. And to unlock supply in these areas, we're transforming residential homes into beautiful, modern micro centers. And by focusing on home-based care, we can bypass commercial zoning laws, which allows us to set up quickly and affordably in areas where families need it the most. So what makes us unique? By law, to be able to open a home-based childcare center, providers actually have to live in the home to meet the qualifications of what's a home-based center. And so we're actually leveraging the requirement by offering subsidized housing to our lead teachers to live in the home while they operate them. And why is this important? Staffing is a huge issue in childcare. The teacher shortage overall in the US is at an all-time high, understaffed by over 150,000 jobs, and turnover is about 30 to 40% a year. So if you're a parent, imagine showing up to your daycare to have a new lead teacher every few months and having to have your child reacclimate to a different teacher and establish that trust all over again. And teachers really are leaving for good reason, and that really boils down to low wages. So by providing subsidized housing, we're actually able to increase their take-home pay by about 50%, which allows us to attract and retain the best educators and in turn provide families with consistent care. So as I mentioned, we've actually targeted West Seattle and Magnolia as our first two centers, or our first two neighborhoods in Seattle, and have built a wait list of over 100 families in these areas ready to join. We're in advanced conversations with a number of real estate investors to buy our first home in Seattle. And we actually plan to scale that way. So we plan to scale with an innovative OpCo-PropCo model, which essentially is partnering with real estate investors and offering them above market yields on single family homes. By being able to operate commercially out of residential home, we can provide them better returns than they would make by simply renting the house out. So overall, what's our vision? In 10 years, we expect Birdhouse to be a leader in childcare and early learning, really reimagining how childcare is delivered. The Birdhouse brand will be synonymous with excellence in early learning and community integration, really a seamless extension of the home that provides unparalleled support, care, and peace of mind for today's families.
Awesome. And just on time too. Thank you so much. All right. Well, we are going to do this, the awkward, very unrealistic situation where we will then kick you out of the room. And I will follow up with some of the sort of the thoughts from the discussion. But, you know, I really appreciate you taking the time to share your pitch and yeah, walking us through. So thanks a lot, Matt. I'll catch you soon.
Sounds good. Cheers, everyone. Take it easy.
Awesome. Great. Well, let me just see if I can do this. Let's see. John, I'm going to see if this will actually work. Okay. Okie dokes. All right. So reflecting on what you just heard, we're going to use this tool called Slido. You can either type in on your phone using that QR code, or you can just go to slido.com and enter that number. But how would you describe this company, what you just heard about, to another investor? So you can just type in what you heard. And I'll give it a few minutes.
When you're in a Zoom room, you can just do polls in Zoom.
It's true. I could. That's a really good point. I had just used this. I think I was taking a slide from some things I used in the classroom, and this is great in the classroom. But I also like some of the interactions that you have here where I can sort of, actually, I'm not using any of those, but there's like a word cloud version in terms of the responses. But for today, we'll use this. We'll see if I can adjust on the fly. And one of the reasons why I've asked this, just while we wait for folks to type, is I think often as an investor, and this is true in most jobs, I suppose, where you're really a big part of the role is talking about your work or the things that the projects, right? In jobs. And this is sort of the work of the investor. You know, for me, I think about it as like, I have to tell Minda about every company that I'm getting really excited about and that I'm moving through a process. When I was an angel, it was often like getting my partner excited about a deal that, you know, we might write a check into, or it might be somebody who is a colleague in the investor world that I think would really enjoy hearing about this deal. So I think it's a really actually important skill to be able to get other folks excited about something that you heard about. So let's see. Folks are typing. Turning residential homes into childcare centers in dense area that have need for high quality childcare. Pretty succinct. And the point here too is that, you know, part of what I'll do when I share this with Matt is that often for founders, what people hear and hold on to and the assumptions that they might have, that's also part of their hopes and dreams for a company, right? And some of the things that they got really excited about. And I think for founders, that can be really helpful. Some slightly longer ones, daycare centers and current childcare deserts through zoning, workaround through providing teachers with subsidized housing, accelerated home-based childcare, birdhouse is increasing. Finally, there's somebody who said the company name, you know, addressing the lack of childcare problem by bypassing commercial zoning laws. Somebody was taking really good notes because I feel like those are some of the exact words I might use. That's awesome. So a lot of specifics there. Now, you know, what I might suggest, and one of the things that we use internally that can be helpful is using some of Dave Parker's work with founders and kind of using that as an investor. So we're saying like, you know, and I kind of use this as well because it's like, it gives me a little bit of a format and a formula to use. So this company is blank, and the problem they're solving is blank. And in this case, you want to try to use one problem, not the 99 problems, right, that a company could be solving. And the product is what they sell, and it's designed for the target customer of the segment. And they will make money through blank, and they are the right team because blank. And I think this feels really maybe simplified, but part of what I love with this brevity is that it does actually bring a lot of clarity to the opportunity, right? And it also clarifies sort of what you don't understand, right? Sometimes we'll hear a pitch and you're like, this must be exciting because the founder sure had a lot to say about like this particular problem, and like there must be something there. But then when you start to write it down, you're like, but like they actually don't really have a clear picture of what they're selling or who they're selling it to. And gosh, I actually really have no idea how they make money. Like then, you know, things start to you start to see some of the gaps of like of what you heard. So given that, and also I would say like, can you fill out these fields without jargon? I think that's really important because founders sometimes get very jargony, especially if they're in a very technical space. And so I think as an investor, it's like, could I hear it and then convey it to somebody who does not have the same technical fluency, and like, will it still make sense? So I will take a volunteer who wants to describe Birdhouse in this Madlib format. Anyone want to raise their hand and volunteer?
Call on people.
Okay, well, I might have to call on Shannon because she also knows this format a little well. Sorry, Shannon.
No problem. I wasn't volunteering because I felt like it wasn't fair. I've done it already. The company's name is Birdhouse, and the problem they're solving is addressing childcare deserts in large cities, starting with Seattle. They are selling childcare that is within a house, therefore able to bypass zoning laws, and by giving teachers the ability to live in those homes, which allow them to bypass these critical laws, they are enabling teachers to take home up to 50% more, which addresses a lot of the childcare problems in continuity. They'll make money by that. I'm still unclear about how they're going to do that in the timeline. I mean, they'll have childcare and they'll pay the $35,000 a year or whatnot per child that at least some of my neighbors pay likely. But the team is the right fit because they have experience starting this kind of company in Europe already. I'm not sure about the real estate portion or the construction section yet.
Totally. A little bit of complexity because they have multiple sort of streams. But yeah, I would say, like, I sort of summarized it as like, this company is Birdhouse. The problem they're solving is real estate and labor limitations, creating childcare deserts. And the product is a home-based micro childcare center with subsidized provider housing. It's designed for their target customer of millennial families, initially in Seattle. I actually really like how he described it in the pitch, which was parent-dense neighborhoods with a high cost of rent. I would have sort of put that in there, but I was going off this pitch deck. And then they make money through management fees from the micro center operations and rent and tuition. And they are the right team because the co-founders bring expertise in childcare and brand building. So you can sort of see how we're capturing kind of the key elements. And, and like I said, Minda and I often do this with our companies, partly so that we can really have a little bit more of like did we ask the right questions to understand all the pieces, right? Like the first question would be like, okay, but how the heck do you make money in our call? And so when I'm describing it to her, I hope I would be able to answer that, right? And so when you think about what are the most relevant questions, okay, we're gonna first have you again fill out this one and tell me the first or most important question you want to ask if you were to do a Q&A. And you're right, John, I should have done this in a poll because I did not use any of the interaction.
It is the problem when we switch tools around.
I know. And it's I actually really enjoy teaching in person. And so I've enjoyed the tools that I get to use in the classroom, but I miss the simplicity, you're right, of the days when we knew it was always on Zoom. So I just got really good at Zoom.
I spent years trying to get all of the investors to use a computer in person, and never happened. I see Moo has his hand up.
Yes, I'm going to ask, what's the problem? What's the pain points that he tried to solve?
Yep. And we'll look at some of the other questions too, where people have said, how much capital is needed to open the first center? The business model, right? I think a lot of folks are really getting into some of the operational things. What's the timeline for making a profit? So Moo's question is a little bit different too. It's actually more back on the sort of problem statement, right? Someone's looking at kind of acquisition. I think the Moo's question is kind of related to is it a painkiller or a vitamin, right? Is this something that is like a nice to have, or does it actually like address, or is there like a hair on fire type of problem that people are trying to solve? All interesting and good questions, right? And I think about when I'm listening to a pitch, the sort of filters that I'm using is, well, first and foremost, you're trying to understand, like, is this thing I'm hearing? You're hearing about the blueprint for a machine that, like, maybe it's built, maybe it's the plan for a machine that's about to be built for pre-product companies, or maybe it's a blueprint for something that you've like hacked together with duct tape and a little bit of like piece of gum around here. But what I'm really understanding is, like, I'm trying to make a decision about this machine. Will this machine, once it's running, be fueled by customer revenue, and you put $1 in on one side, it spits out a bunch more money on the other side? And that's really what I'm investing in. And so the key things I'm trying to understand is what will increase the company value? What makes this company like more valuable, and how does that grow? And do we understand sort of the key assumptions and key levers behind the strategy? And then what's the relevant to my decision? And we sort of describe these as like, what are the miracles that need to happen for the company? And then what are the fires that like will strain their efforts? And those are really where you're trying to get clarity. And that should tell you the most important questions to ask. So, okay. So when we map the Mad Lib now to some of the questions that come up, like what is the pain point really? What other issues create childcare deserts, right? I think when you're asking these questions around like the pain points, you're sort of saying like, are the ones you've identified around like real estate and labor limitations, is that actually the problem? Do I believe that? And that could be a fire, because maybe we'll actually find that there's other constraints that they aren't addressing that will sort of potentially like hamper the business. How does this operationally scale? These are the questions that folks were asking around, like, I just want to look at the spreadsheet and do the numbers a little bit, right? And that's a little bit of the miracle of like, can I get 1 operational? Can I get 2? Now, can I get 100 across the country operational? That's a miracle, right? And what is, in terms of the families, it's like, what additional segmentation might help improve? But I sort of foresee high acquisition costs here when you're talking about consumer customers. Acquisition costs are usually high, so that is a fire for me, right? The acquisition costs could sort of make your LTV to CAC ratio like kind of not quite jive, and your operational metrics again fall apart. And then does this net out? I put this both as like a miracle as well as a fire, because it's both talking about like, does the operation make sense, and are there potential things like a literal fire at a provider's home, or some bad behavior by a provider? Like, what are the other sort of negative things that could kill that business, right? And then what skills are really important to actually making this work? And I think also as with any team, I'm usually asking like, is this a high functioning team? So taking this further, I then map these kind of questions to these various areas that I often look at for companies, which is like, you could see like things like market landscape, team and cap table, traction and go-to-market strategy, product and solution. And you can sort of see that like market, landscape, and team and cap table get like the highest number of arrows pointing to them, right? Versus what founders love to talk about. And I think actually as angels, a lot of us are like product people at heart to some degree. We always want to sit there and talk about product and solution like a ton, but you can see that like there's less of those kind of arrows pointing at like the importance of the product. Now, in this particular case, I think there is a very real question that is a spreadsheet based one about the operational kind of piece of it. But I think like that to me is like a spreadsheet exercise for you to do in the middle of the night, versus like to really rehash and hash out over like the coffee. Like, spend your time really digging into some of the areas where there is more kind of heat. So if we look at just market and landscape, what I want to know, and this is an important sort of distinction, like what I want to know and the questions I ask are a little bit different, right? What I want to know is like, what does this team actually know about the market? How well do they know their customers and sort of all the stakeholders there? And then what are the things that they have that might provide some unique perspective here? And so, but like, if I ask that, like, that's not going to give me a very satisfactory answer. So I might be asking questions that are about like, how would you categorize your competitors, right? Tell me about the whole landscape, and like, what is the advantage you have over each category? Or what are the things that you observed, or what are the experiences you had that led you to this idea, right? This is giving me a little bit more color, but what I'm listening for are these things, right? So I often, the question you ask and what you're listening for are slightly different. I want you to be aware of that, right? From the team perspective, I need to really deeply understand what are the skills that I think are needed for this opportunity? I'm like, what am I observing about this team and how they work well? I'm like, also ultimately, do I believe that the CEO can lead? And so those are some of those, like, what I want to know. Those are more observational, right? Like, if I ask Matt, like, can you lead and make really hard decisions? He'd be like, heck yeah, of course I can. But what you're asking questions. I mean, this is sort of true of a lot of interviewing, right? Like, you're asking the questions that give you observational data that allow you to make those decisions. So, this is just an example of one of the worksheets, the forms that Minda and I have used in the past that kind of help us take notes. And so as you're looking at the deals, feel free to think about using some sort of a format that helps you capture similar sort of capture information about deals in a similar way, right? Because that really helps you kind of compare apples and oranges, and at least like in a slightly like more uniform way, because every deal will have slightly different kind of parameters. And always just remember that you're always making decisions with incomplete information. Like I said at the top, if it was spreadsheet math, it'd be much easier to go, yeah, of course it's this company, not that company. But in this case, you're going to have pre-product companies, post-revenue companies. You're going to have like companies with first-time founders, with like multi-time entrepreneurs. And there's always going to be, especially coming from, let's say, a big tech perspective, you're going to have laughably small sample sizes. And so, there's, especially when you're making group decisions, just know that there's not really any right or wrong answers, but and what I consider to be like a big risk, definitely a no, might be the very same reason where like somebody else, Kristan, says, actually, that's the reason I'm leaning in. So I think it's really important as a group to talk about and separate data, observations, and opinions when you're having discussions, because that will help you triangulate better on like kind of what you can agree on and like where the differences are and what might be driving those. So really quick, that was kind of a quick run through, but hopefully, happy to kind of talk and discuss more about this deal, about the questions, but just, that's kind of the end of it. I always like to sort of have an end with like, where can we see each other around town? So, Ascend obviously has a really big founder party coming up in September. That is purely just fun. And then we have, our version of fun, which is doing something similar to what we just did, but actually going through and having a discussion about the deal. And we do that virtually, called at an event called Deals and Drinks over Zoom every couple months or so. So, we'd love to see you there, and, dive into a couple more deals together. So I think that's it. John, should we go into questions or discussions? Oh, you are muted, I think. Are you talking? Yes.
Yes, lower your screen and then we can chat. So here we are.
Yep.
So a lot of what you went through are sort of foundational stuff. I wonder, one of the dangers that we have from Seattle Angel Conference is that we get experts in their technology diving deep on the things they know, and not giving enough care to the broader set of things that are vital. And so maybe you can talk about the breadth of things that we should be thinking about a little bit more.
Yeah. I mean, I think, when I breezed through really quickly, the market, team, sort of like traction and product. And it really, I do this. I want to talk about product at depth all the time. Really want to understand, like, well, have you thought about this? Have you thought about that? But really, that's actually only part of it, right? Another sort of vector that you could use is like desirability, viability, feasibility, right? Desirability often, like, have you covered all of those bases? So use, whatever easy to remember framework that works for you. right? Whatever jives with you, and kind of use that as your sort of like note taking. And I usually, when I actually open up a conversation with a founder, I pull up a little doc, and I have like product, market, like, go to market, fundraise. Like I have my categories of things that I want to ask people, that I want to make sure we cover, because I think it's really important to kind of make sure that, like you said, John, like I don't sit there and spend 30 minutes talking about one section. I have all these notes. And then when I go back to report to, Minda about this great founder I met, and I think we should talk to them. And she's like, okay, well, what's their like go to market? I'm like, oh, we didn't talk about that. Like, that makes it really hard to assess kind of the potential validity of a deal. And so you do, I would say, like whatever kind of whatever, I don't know, scaffolding that you can build for yourself to make sure that you cover all those bases. I think, use those. And again, just know your bias. I'm like, I will stop myself with founders to be like, we could talk product for hours. That's another conversation. And I'm now going to focus on this other place.
I put into the chat a list of things that are sort of the core bones. Most of it is the lean canvas, but there's a few more things that we've been talking about that are inside there, and they sort of frame the skeleton of the startup. And then if we dive down and try to understand in detail what that is, then we're going to create ourselves some trouble, right? Because uncertainty will come and engage us very quickly, right?
Yeah, I think you're totally right. And it is, and I think on one hand, a lot of experts will say, hey, you should invest in areas where you have some expertise. And so people go, oh, I know something about the space. Therefore, if I can like sort of get all the gotchas and I can poke all the holes, I must have found a good deal. And I think that's a little, I would think about like where your expertise fits a little bit more broadly than your narrow place, right? When I was at Google, I worked on books and news. I've worked in an ed tech company, I've worked in an ad tech company, but broadly tech and operations, right? And so I think about what is it that my experience, having been in partnerships, having been in operations, having been in product roles, like what expertise do I have from that standpoint in a more general way, not in a deep vertical way? And I use that as sort of where I have expertise versus right where I don't. Like I think Jeff Harris likes to talk about like aquaponics and like hydroponics. It's like, yes, I do not have expertise in lettuce farming, but I might have expertise in we actually, one of our companies in our portfolio, it's a company that is a 3D animation creation company, right? Do I have any experience in production, in animation? No. But do I understand some of the motion of what they have to do in working with media brands and companies and like, do I have a good understanding of how parts of their go-to-market, like the stakeholders in their go-to-market talk to each other? Like, absolutely, right? And so use some of the expertise that you have from your work experience to broaden some of the ways that you look at a deal.
So one of the advantages of our active angel fund model, where everybody's participating, is that our expertise is the sum of all of the expertise, and maybe even something more than that, because our interactions create expertise, as well as the network that we have provides us the ability to bring in expertise. And so we shouldn't narrow our box down a little bit.
I think you're right.
That. But
that
you brought up Jeff Harris's
and that company's doing well though.
I understand, but we have this investment opportunity to invest in all of these platforms with software, and in that particular round, we bashed them to pieces and said, "Oh, these are horrible businesses because we've tried that at Microsoft. We can't do that. Oh, look, a pretty lettuce company. We can do lettuce, of which we know nothing whatsoever." Now, there's some luck involved in the fact that it's still going and doing something interesting, but we over-index sometimes on what we've done before, and under-index on the the high, bright shininess of things we don't know anything about.
And
I want-
I think that's such a good point, John, because Minda and I describe it as like, can you suspend judgment when you're looking at a company? One of our top performers in our first row portfolio is an ed tech company, and Minda and I both worked in ed tech before, and so I met somebody said, "Hey, Yoko, you should talk to this fantastic founder. She's doing VR STEM education for K-12," and I was like, "Great." I heard a lot of things that like I do not like. And so I remember writing to Minna and said, I think I'm gonna have a great mentoring conversation with this founder. But when I approached the conversation, I did write down like what would need to be true for this deal to look interesting. And when we had the first conversation, I suspended judgment. I kind of like, I sort of stopped and said, like, what could be true about this company? And turns out, I mean, this founder also was one of those like unicorns where she had been a teacher, she had been a curriculum provider or writer, she had been an administrator. So she knew all the folks in the chain that makes K-12 sales really hard. And in fact, she had already sort of just like blown a lot of the sales projections out of the water. And so, it was one of those cases where because we were able to have a deep conversation and we suspended judgment, we could actually, get 1 or 2 levels deeper and dream that of what if this company was wildly successful.
Yeah. So other folks have questions? Vinay. Oh yeah, go ahead, Christiane.
Well, so we're gonna, in a few weeks' time, we're gonna go through 60 plus 1-minute pitches, and we will get an opportunity to go into breakout rooms and talk to people both before and after those pitches. Like, do you have any advice for people on like how to think about formulating questions, prioritizing who you're asking, that sort of thing, because it's overwhelming for the first, especially if you're a first-time person, to like go into that mayhem. So.
Yeah, well, some of it too, I think, especially I think as humans, there's a little bit of like we hate silence. And so there's like, I'm just going to ask the first question that comes to mind. But rather than that, like, I think if you take that moment and go like, what would, and I would say if you're thinking about asking a question, I would also take a moment and go, what would I want to hear that would change my decision, that would make me either lean in or lean out, right? Because if you're asking a question that's just more like curiosity, like, oh, are you going to launch that feature? Like this, wouldn't this feature be cool? It's like, yeah, totally. Like, and founders will like dream with you. And that doesn't really give you anything except like happy stories versus what you're really trying to understand. It's like, hey, like, with the go-to-market, like I'm really concerned about, I don't know, the high cost of acquisition. So like, what are you doing to mitigate that? Again, like the answer there will tell you a lot about like, do they really understand the challenges in the space? Do they have a plan to sort of like improve? Of course, they might not be great today, right? Acquisition costs are everything is kind of terrible, but they should have a plan of things getting a little better. Shannon?
So Matt took far longer than a minute, obviously, and the minute is very short time period.
Yeah.
What are the flags that you would look for if someone doesn't, in a minute, discuss? Is it the finances? Is it the traction? What if they don't even touch on it?
Yeah.
What would you be like? Mm-mm.
So
yeah. Go ahead.
The important piece in this context is you will have had a week to review their GUST profile. And so it's not like you're coming in as a vacuum in the elevator.
Totally.
The question is, in my mind, the important question is, and I think what Yoko was pointing at with the decision of should I lean in or lean out, that question, you're trying to sort these companies into boxes. So the important question then becomes in the 1-minute pitch, do I care that this person does this thing? And do I care if this thing exists in the world or not? Right? Not that I understand what it is that it's doing. The question is, do I want to find out more about this? for me, I have an investment thesis that I don't care about gambling. And so anything that looks like making gambling easier or better or more fun is like really quickly a no for me, right? And I just put them in the no pile. So think of it as triage. I have three
Yeah.
piles. This one I really care about. If this happens, it will make the world better in whatever way I care about. This one I don't care about at all, don't want to do it. This one I'm not sure about. What question could I ask that would move them one way or the other?
Yep. And I think there's two pieces that I'd add to that too. One is, Shannon, to your questions, like what area, if they don't talk about it, like will be the red flag devastation. And I think it really depends, right? I always think about it, and Linda and I talk about this a lot, is if the company is, they're pitching to you that they are building they're going to have a monkey on top of a flagpole speaking, like reciting Shakespeare. And that's their like idea. And they spend the whole 1 minute talking about like how they went and bought all the component and pieces of the flagpole. That's a flag, right? Because what's really hard about that problem is the monkey speaking, period, and then reciting Shakespeare. And so if you're not talking about like the actual thing that makes sense, then, or you're not even referencing them, to me, that's a little bit of a flag, right? So during that week, right, you're kind of, I would sort of do that sort that John's sort of saying, and then like, think about like, what is it that you think, or the founders should understand what makes them unique? Is it a unique positioning within the marketplace or within the market? Is it some sort of like, eye-popping stat that shows signal of market demand? Like, what are the things that make them interesting? Are they pulling that out? And the second piece is like the first couple cuts, especially in Seattle Angel Conference, can feel really jarring and sometimes like maybe even a little cruel, because you're like, I have such limited information and I'm now making a snap judgment on this thing that somebody has worked really hard at. And that feels really hard, right? I think there's no way around that. But I think one of the things when we do this, and I would say the fund management, John does a really great job of doing this. And this is part of the role of the fund managers, like conveying to the founders, it's like, based on what you submitted, this is what we heard or saw, right? And I think for founders, this is a great place to learn like what I'm saying and what people hear, or what I'm presenting and what people see are very different things. And trying to like move those things closer together is the work of the founder, right? And so I think know that like that will feel sort of jarring, but the more transparent you can be and kind of like, I don't get this, I think this isn't clear, that makes Kristan and John's job a lot easier when you send that back out to the founder and sort of course, in a kind, anonymized, way of like, here's the gap, because there will always be gaps in what you say and what people hear.
And to put that in context, we want everybody to make comments on the Gus profiles every time they engage. And so that collection of the sum of all the comments gets digested and given to each of the companies, which is the feedback mechanism that allows them to get stronger.
Yeah, Vinay, your question about sort of the objective metrics, I think the Dave Parker has a great blog post about different revenue models. And so I think that is a good place to start, because I think depending on the revenue model of your company, the sort of KPIs that really matter to show the health or sort of like give you some signal of, is there something working here, are a little bit different, right? And so I'd start there. When you get into later rounds, say like by seed, there's certain like MRR metrics that are fairly typical. By Series A, it's like, it used to be 2 to 5 million. Now it's like, or it used to be 1 to 2 million. Now it's like 2 to 5 or even more. So I think it really just depends both on the business model and then sort of the market that's out there. Did you have follow up on that, Vinay?
A lot of those metrics are things that require you to dive into their financial model to get context for them. So be careful about quickly deciding about a metric without context. Go ahead, Vinay.
Right. Also, I think revenue is something that can be objectively measured, but how do you measure team? That's how do you objectively put that into perspective?
We had a
Yeah.
nice long conversation about that in our open coffee this morning.
Sure.
Oh, what were the top 2 takeaways, John?
That all of the efforts to create tools to do it don't work, and that it's a question of the interpersonal intuition around team ability to have a fight and still like each other, grit, persistence, ability to communicate, and a collection of interpersonal skills, as opposed to little checkmarky things.
Yeah, and
What
often with
did,
team.
Vinay was in the middle of that conversation, so Vinay, what did you get out of it?
Sure, I understood how subjective this can be, right? When we are trying to put this in context and trying to see how do we absolutely evaluate a team, unless and until you absolutely know these people, how do you make better judgments?
I think the use of the word absolutely does not understand the notion of error bars and uncertainty in startups.
Sure, okay. How do we move the metric in
Yeah.
such a way that it gets better?
Yeah, I mean, like there's a few signals that we look for, right? Like I say when I get a pitch deck from a founder, one of the first things I'm doing is I'm often going to LinkedIn. And what I'm trying to glean from LinkedIn is, especially in the space that they're in, do I see a path to them having a unique perspective within this space? Right? You're building a new robotics company. Okay, what are the types of things? You're building a robotics company that will go to the moon. Okay, cool. Like what in your background suggests that there's something there, right? In sort of, I would say, deeper tech areas, PhDs, so specialization can matter. But in other spaces, it's, let's say it's like, okay, cool. Are you a tinkerer? Are you somebody who builds? So I think when I'm looking at the LinkedIn, I'm both looking for unique perspective, but I also am starting to see signals of 2 things. One is, is this person somebody who like tends to build, or are they really good at being kind of a middle, I would say like a sort of a cog somewhere deep in a machine? And do they have the ability to attract and retain talent, right? Those are really key things for founding teams to be able to do. They got to build, they got to ship product and execute, and they also have to like build a team around them. And those are, some of the things that it's really hard to see out of LinkedIn. Some people, especially if you're coming from academics, you just have like all your things listed. And it's like, okay, what's that matter? But I think for founders, we're often coaching them that that's part of your branding exercise. Does everything kind of consistently make sense? And then as you're talking to the founders, those are pieces as well. But like take AI companies, right? Knowing that the bar for a good AI company, or the starting line has sort of shifted because there's a lot of sort of easy out of the box things. That's really where I'm like, oh, did you just pick up like one of the companies we invested in? They're in sort of the AI for musical creativity space. And but they've also been in the space researching, writing their PhD dissertation on the subject of AI and creativity. Gosh, that probably suggests that they might have, they've been working on this for more than a couple years or a year, and that might give them a little bit of an edge. Does that help give you a little bit of like more sort of not, it's like a little more than it depends?
I think, sure. I would let other people ask questions.
Christine?
Well, I was going to say that I also like to see that the team complements each other. And so like when they present a team slide, it's not just, oh, here's this person and they've got a degree in this. I want to say that like you said, this is our builder, this is our communicator, this is our, whatever. But like, I want to see that they are complementing each other. I was talking to somebody recently who wanted to apply, and he's like, well, I'm a solo founder. And I said, well, we don't often invest in solo founders, not because we don't think that you can do it by yourself per se, but we want to see, like Yoko was saying, that you can attract a team and that you're a leader, right? And that's what's the best way to determine if somebody's a leader? They've got followers, right? So we want to be able to see that you've got some other folks who have signed up for the journey and they're gonna be following you into the fray, right? And if somebody just says, I'm a startup founder, like that's, a solo founder, that's a big red flag for me. And I'll see it in Gus too. Like they'll have a team slide, but they won't list their team in their Gus profile. So it makes me feel like they're undervaluing or something, their team, right?
Totally. And I would say like it's often when you're going as somebody, let's talk about that 1 minute pitch. It's like, if they don't talk about the team slide is not necessarily the only place you talk about your team. Right? You're sort of like weaving little bits of it throughout. And that shows how much you like respect your teammates, how you really understand kind of like what they're really good at. It might also show a little bit, you don't have to like spend every waking moment with them, even though you will spend a lot of time with them. But like, you don't have to be besties, but you have to be able to functionally work together. And I would say that, Kristen, that pulled up a little bit of I would say like a yellow minor flag of when people, all the founding folks, the people on the founding team or on the slide don't list in their LinkedIn. That's a little bit of a like, what is actually happening here? Is this like a stealth situation? Especially if let's say like their CTO is also working at like 3 other startups too. I'm like, is this a dabbling thing? What's happening? But Margot, yep.
Yeah, I'm curious. I think probably you and Minda have, your investment thesis and experience in, like the founders who come to you are within that thesis. But for SAC, I'm curious, there's a wide spectrum of different companies, different industries. How much, for questions like competitors and industry trends and the market, how much are you kind of grilling them with those questions versus doing your own research on, what that industry is looking like and who the competitors are?
I think, John mentioned in that first cut, right? You're sort of doing the quick sort of like, do I care? Like, does this need to exist? You kind of do that initial cut and then like take that bucket of, let's say it's, maybe a third or so. And you're just saying, okay, cool. Like, what do I know about this space? And in some cases, like I have been on calls where an angel investor is like, I know nothing about the space, but I was just Googling during your, 5-minute pitch. And I pulled up like 3 competitors that like are doing the exact same thing as you.
Yeah.
And so I would also, I would take that third and maybe like, again, prioritize and rank them maybe a little bit and sort of say like, which ones call to me the most? And they might not be where you have some expertise. Maybe it's a hydroponic lettuce farm again, right? Or a space junk company, right? But you get drawn to this company, like there's something like, I don't know, maybe it's just their like flashy slides are really pretty, cool. Something has, pulled you in. And so like lean into that a little bit and just look up, do a couple searches. And then, does this sort of corroborate what they're starting to mention? And like follow that a little bit. But given you have so many companies, I would maybe like time box it a little so that you can get like shallow depth. And then as they win more of your time and you win more of their time, then you can go a little bit deeper.
Okay.
Yeah. And Kristen, totally red flag. If somebody's like, there are no competitors, I'm like, okay. Why? Because was it not interesting to build there? Potentially?
Nitesh?
Yeah, my question is around what kind of structures have you seen within founding teams? Meaning, do you see like a CEO and a CTO and like some CEOs, or do you see some other titles? So if you could like share some more, some examples of structure that, yeah.
Yeah, I think there's a few, so there's a few, I would say, schools of thought here. I know John probably has some opinions here, but like, for example, YC is very much like, oh, everyone's a co-founder, you don't really have titles, and you're all equal owners. And so you'll come into a company that's like 3 co-founders, and they all have 33.33%. I'm like, I actually don't like that, because as an investor, you're sort of trying to figure out like who's leading the charge, and also what are the roles that and responsibilities of each person. So I like to see some clarity there. And so typically what we end up investing in is there's a CEO, right? And they have the, I would say, like controlling ownership of the company, right? Sometimes they're, and so, you know, they, again, they should have decent enough ownership such that they can be, you know, they're sort of pushed down the lid, but they'll still retain sort of like the majority, not majority, sorry, wrong, but they actually have like, again, controlling ownership, because you don't want, if you think about that third, you know, it's over time, you're suddenly now in a situation where the folks, the CEO who you really want to have retained in the long run, and you bet on that person, and now they have like employee level kind of ownership, and then they start to go, you know, 5 years in, they start to get kind of itchy feet because the opportunity cost is starting to, you know, add up for them, right? And so that's part of what we look for is sort of like, who am I investing in? Who will sort of endure? Yeah, I don't know, John, you've seen a number of different configurations.
Yeah, I think the even split, however you do even split, is a terrible idea. It's a red flag for me because it means they haven't actually thought out who's taking what responsibility. And different responsibility has different value. And one of the values is who gets to go down with the ship when it fails and clean up the mess when it's done, or who's the one that has to take all of the, when you make a mistake, who's got to stand in public and take the mistake. That person is the CEO, and that person needs to be at some level the decision maker that can make or break a decision immediately without consultation at some level. Consultation when things are not in crisis makes a lot of sense as a team building activity, but when everything is in trouble and you have to cut off limbs to make something survive, there's one person that gets to make those choices. And it shouldn't be without compensation.
And there's a couple of equity calculators out there that can be helpful, because the other thing is that the equity should be a reflection of sort of who is most important in building the value of the future. So it should be sort of the future building process, not we've both worked and like grinded on this for the last like 6 months, and so therefore like it's not a recognition of your past work, but it's really about like kind of the long-term value building. And so a couple of the equity calculators out there help to kind of start to do that math a little bit, and so for co-founders, I often tell them to like do that on your own and then come together and like discuss what percentages you have, but because that can sometimes be a little bit jarring for folks.
The other side of that conversation is some people are very willing to put themselves into a box. We had a conversation last week with a founder who the majority of his team are coders who don't want to talk to anybody. And coders are great. They are necessary, but they're not co-founders when they're not salespeople. And so the founder is the person who rows the boat with all the other founders to get to a place, and they can tell the story of the company. They can interact around what we're doing, and they're playing a founder role, not a coder role, or even an architect role, right? If I'm a technical person in a technical box and I'm doing zero of the business founder work, like I ought to, as the CTO, be able to pitch the company if I have to, right? Not that I'm the right one to do it, but when I have 3 pitches to do and the CEO's off one way doing one pitch, you do the other pitch, that should be a normal capacity that's not a fight, right? And when this particular CEO was saying, hey, my guys don't want to do that. They're like, don't want to talk to anybody. They just want to be alone and do coding and be left alone. Well, for me, that's like, okay, you don't have co-founders.
Yeah, and I
we
think that especially, I would say that framing is also super problematic because I think especially at the earliest stages, you don't know what product market fit looks like, right? Like you're building a product, and how can you build something that people will use if you're not talking to your users and you're not out there kind of testing all those things? So I think for engineers, you're right. A lot of folks want to just be kind of like, I just want to build. It's like you kind of have to be more of a product engineer and really thinking about like really consider yourself to be like actually like customer facing in a very different way.
Yep, we just did 2 workshops on that, and we have another one coming around doing customer development before product development. So
Yeah.
I do have a follow-up question. I think Yoko mentioned about part-time founders. So if there is a situation where there is let's say a full-time person who's, let's say, the CEO who's most invested, and there is a part-time founder, is this kind of team okay? Have you seen an invested?
Yeah, I think totally. I'm trying to think of like our portfolio. We have not invested. We have invested in teams who probably had like part-time or like contractor work, but not with the co-founders. Now, I think again, as an angel, you'll see some things that are a little bit earlier, right? And so sometimes it's like, hey, we need to raise because this, the reality is the cost of living is the cost of living. And would I rather have this person, in that role, like taking some small amount of salary that allows them to like not to work on this full time and not have to like drive Uber and like DoorDash? Like, yes, I would like that. And so sometimes the first round that somebody is raising, they might say, hey, we're raising this amount. And that allows like all of our team to come full time. So I kind of I do want to know, when are you all going to go all in on this?
and this leads into your conversation about milestones, and what the structure of the milestones are as you go forward. Most of the time, the founders are thinking in terms of operational costs. How do I make the operations work so I can make it go? From an investor point of view, we don't care about the operational costs. What we want to know is when I put in the capital, what's the transformation of the value of the company? And if the founder doesn't understand that question, then part of our goal is to communicate with them around that so that they understand that spending money on salary, which doesn't change the value of the company, is not a good answer, right?
Yeah. And especially,
it's very difficult for them to tell the difference between paying salary that is OpEx and paying salary that is CapEx.
Yeah. And I think I often ask founders too, it's like, okay, but other than this round of funding, like, or sometimes, right, I'll meet a founder who is not fundraising, but they're like, hey, I'm building this part-time and I kind of want to know, I'll leave my company at some point soon. And I kind of go, what needs to happen? What is a signal you're looking for that would make you leave the company? And I always want to be thinking about it as, are you starting to see signal of customer validation and actual signal that the machine is starting to work, versus if they said, well, when we raise money, then I can leave, as in like, it's really, again, it's much more related to the sort of like operational side of things. I really want founders to be focused on the milestones and the sort of the things that happen in the business that shows that the business is starting to, like, the machine is starting to sort of function, even if it's not well.
Right. And so I divide the world into 2 things: people that are bottom-up investors and people that are top-down investors. And so Rob Wilbank, the professor we rely on a lot for our data, calls them earners and burners. I'm an earner kind of perspective. I want people to have clarity on how they're going to get to cash flow positive. I want them to be tracking that hard and driving that hard. And then we'll worry about getting bigger faster after we get to stable. Where burners are all about raise a lot of money, get really big fast, raise a lot more money, get bigger fast, and then we'll worry about stable later. I think, especially in the current context, an earner company is a better company for me.
I think a lot of investors would agree.
Hitesh, are you done?
Yeah, I'm done. Yeah, thank you so
Yep.
much. Very insightful.
Yeah, so I noticed that like some, especially in my field in SaaS, a lot of CXO, they start their own company, so they want some type of structure. So in your opinion, is the experience in the field or being young and scrappy, which one is more important?
It's a good question. I think in Seattle too, you see a lot more folks from industry with some depth of experience. And I think it really depends. There was something I was listening to around. It was like I think it's Power Law. It's a great read, but it really they basically say like Khosla from Khosla Ventures loves people who come from outsiders or outsiders in an industry to really disrupt it, because you, to some degree, and I agree that you have to be somewhat unencumbered by sort of the restraints of the system, right? My dad's been in commercial seafood for like 30, 40 years. As a result, every time I bring him a deal that looks, I'm like, oh, isn't this interesting? This company is trying to disrupt this part of the supply chain. He's like, I wouldn't work because 20 reasons why, right? And so it's really hard because for him, a lot of the sort of systems have been calcified. So I do think that to some degree, you have to have a little bit of this like outlier and outsider perspective of like what could change. And some folks would say that might come with being new in a space or being younger. But I think it's more of the why might you have that slightly outsider perspective? Why might you not be kind of like sort of, we do this because this is always the way we've done it, like and that could come from a lot of different places. So sometimes it's because, for example, we invest in a company that is run by a clinical psychologist, right? She knows her space around like empathy extremely well, right? She has, a lot of time researching that, but and she knows the system. But if I look in her past, it's like she has some entrepreneurs in her family history. Who are the people around her that might be pushing her to go, hey, actually, I'm not your typical like psychologist. Does that help?
Yeah, thanks.
So Vinay is talking about the contradiction between having past expertise
Correct.
and having outside view, right?
Yeah. And part of what I would say is sometimes for our founders, right? I look at it as sometimes if you have been part of non-majority voices or perspectives, that can automatically have some I would say can sort of have oriented you as a little bit of an outsider and outlier anyway. So I'm not surprised to see that out of our 22 companies, 14 have female CEOs. That's off, and they also have expertise, right? The 3 PhD company I referred to earlier, musical creativity, they are two folks that are, I would say, heavily underrepresented in the AI world. And so it's like, yeah, they would sort of approach things a little bit differently. And so, yes, I want to see some of there's like requisite expertise, but then you also kind of, so I don't think of these as mutually exclusive. I think you can have both of those things in the same person. Does that kind of help a little bit? You're right, they kind of feel a little bit against each other, but I think there are different ways to sort of see where there are different places from where the outsider perspective can come in.
And another place that I think is useful is to think about the process that we're going through as a process of getting a movie of the evolution of that founder. And so the way the founder thinks about the problems is what we're going to care about. And as we bring up issues to them, we expect them to evolve their understanding at some level. And we're looking for that evolution. And so it's not like they have the skills, okay, we're done. It's like, okay, the world is a mushy place, and I'm identifying a hotspot that needs to be thought about. How are you going to adapt to that in your worldview? Did you already know about it and you already had a plan, or did you know about it and you're not worrying about it because it's just not the thing that's going to kill you today? Or, was it a brand new news, and now that you've thought about it, you're going to put it in the hierarchy of things to pay attention to? But now your hand is still up.
So I think One question that I wanted to ask, assuming you do decide on making an investment, now, how do you make sure the team, company, founder is still executing to the opportunity that was promised to you? And at what point in time, as an investor, should you intervene? Or what warrants an intervention?
Or can you intervene?
Can
Yeah,
you?
sure.
That's a very good question.
Yeah, Yoko is a VC, so my question's more on the VC front, but angels probably have less leverage.
Well, to keep in mind again, as VCs as well, we're often participating in. We don't take lead positions, and so that's we recognize that as a limiting factor. We don't take board seats, and so typically, I would say like a lot of times boards aren't like established even till like seed or A anyway. So it's like a little bit. So in terms of actual like from a governance standpoint, there's limited intervention. Right. And I think a lot of us are relying, both angels and I would say pre-seed and early stage VCs are relying on sort of the soft skill approach of really understanding kind of the founder, what they're working towards. And one thing I would say is I'd hope you've done the sort of like relationship building and some of the early filtering of like, will this person actually go build the thing that they said they would? That's like a sort of basic maybe ethics bar, right? Like I hope that they would meet that. And then given that, it is a little bit of like when founders often will send like a monthly update, a monthly investor update. Maybe it's quarterly, right? And it's looking at those and giving feedback. I try to respond to every update that I get from our founders. And it's usually, and sometimes it's like, hey, you know what, the last 3 months, you've sent sort of like it seems like the growth is stalling. Tell me what's going on there. Or hey, it looks like your last update said that you have 2 months of runway left, which is terrifying and jarring. And like, what, are you actually actively fundraising, or is this like an alarm bell that's ringing, right? So I think often it's a little bit of you building some of that rapport and kind of that understanding a pulse of the business. I think that's one of the things that is the fun part of the follow on and following the company's success. And we have, and the reality too is that sometimes you will be working through, hey, have limited runway, metrics are not going the direction that we expected. And so it is also coaching founders through what does that look like. One is, and one thing we work on with our founder, we worked on with one of our founders, is like the way you close down this business is essentially how you will set yourself up when you come back to this game, right? If you have sent me no updates and then I get an email out of the blue and it just says, hey, we're shutting down. Okay, that happens, cool. It kind of sucks, but that's all right. And then, 3 months later, you're like, hey, Yoko, do you want to invest in my next company? Likely not going to be. I'm like, I didn't see any sort of progress, right? And I didn't really understand sort of your learning in this very hard game of entrepreneurship. And so, with this company, we've only had one company out of the 22 so far close up, but that founder did a spectacular job, I would say, of really keeping us informed along the pathway of what he's learning around, like, is this an M&A possibility? Is this option open? And he was very communicative in those last few months. And I think that really set us up for having trust in him. And when he's back in the game, we have more data about his ability to retain and attract talent and to actually build the thing and like execute on it. And we have some good observations around that. And so, sometimes it's also coaching founders on that side of things as well. I think there's also a certain amount of like, hey, the reality is that sort of the default state of these companies when we invest are that they are like, there's active sort of decay happening, right? These companies, the default is that they will fail. And so you're finding those miracles that can happen that will kind of potentially put them over and, try to identify those pathways for them.
So you made a comment about the more objective I get in the terms of the model, the more subjective it gets in line with the above discussion. I didn't understand the statement, but you keep pressing for objective, and I suspect that the level of uncertainty that is available in pre-seed and seed is beyond the ability to be objective. And that you have to be subjective. You have to make decisions with uncertainty. And there is not an answer that you can calculate. And so when you try to, apply the MBA valuation equations against the startups, they simply do not work. They give you infinite answers or zero answers or some crazy answer. And it continues to do that well into the Series A level of data. And so we're like way down where we've got bubble gum and string and a whole lot of hope in the center and a definite belief in the company. And in the founders. If we don't believe in the founders, then there's no point in going any further. So what does it take for you to believe in the founders? For certain, it requires communication and honesty and integrity. It also is some display of competence, right? But you have to hope that they have some mechanism of learning and getting better and better over time, because they're in the middle of uncertainty that they have to then discern the right answer out of. And all of that is, particularly subjective and mushy stuff.
And I should say, founders also struggle with this, right? They're just like, why? Like, can you just tell me what I need to do in order to get funding? And I'm like, I wish I could. Or can you just tell me what I need to do in order to be successful? I'm like, if we had that checklist and we had that formula, I would say like angel investing would not really exist as a function, right? Because there is a lot of this sort of the subjectiveness of the asset class that is really interesting. And it is part of the, I think, the experiential learning of the space.
Hitesh?
Yeah, my question is about so today I learned that there is a third option in whatever we are doing here. Like the first option is do not invest. The second option is invest and mentor. The third option is mentor only. So can you talk about this third option a bit more, and what would make me sort of gravitate towards this option versus the investing plus mentor option?
Yeah, I mean, like, I think there's some cases, there's a angel in town. I don't know if you've come across, Christine, I know you just met him, Ron, he and I did a few rounds of Seattle Angel Conference, and I think he's a great example of this. He does invest in a lot of companies, but he also, I remember when we went through Seattle Angel Conference, he would actually go through and like choose a bunch of the founders that like didn't make it to the next round that he had some sort of interest in, whether because there's something that really caught him in their pitch or what have you, but he would actually reach out to them and say, hey, you know what, you didn't get, of course, like following the fund manager's kind of process, but he would say like, hey, I have some feedback that I'd love to share with you. Can we sit down? And again, also leaving it open to the founder. I think it's really, I would say it's kind to be really clear that it's like, hey, you know what, I don't think this is an investment for me, but I'd be happy to, walk you through some of the questions that I had and the concerns that stood out as reasons why it sort of removed this option for me, right? And in that case, like in some cases, half the founders won't take you up on it because they're just like, you said no, I don't care. Some of those founders will say great, and then we'll have that meeting with you and try to spend it like trying to convince you that you're wrong, which is also fine. And then there'll be a number of those who will say, hey, awesome, this is really helpful, can we have that follow-up conversation? So I think often when you are not investing and you do mentor, that's sort of where I think the burden of proof to be a value add person who is providing advice is sort of the onus is on to sort of like show up and do that, right? It's easier for me, frankly, to be able to say like, hey, actually there's a bunch of founders I'm like, you are outside of our thesis, but I have a mentoring calendar, you can always book time. And so often I have long conversations with founders, or long-term conversations with founders over a number of months or a number of years, where I do follow up and I'm like, oh, what happened there? And like, we could be a little bit of an objective sort of like wall that they can bounce ideas off of. And sometimes for us, like the founders find that really freeing, because I have no sort of vested interest in telling them something that is, untrue. And so we can actually dive into like, oh, you got 2 term sheets. Awesome. Congrats. Like, let's talk about why you should take one over the other. Or like, hey, you have 2 pathways. You want to go through a pivot. Like, what are the ways that might be interpreted, and how can I help you with that? So I think when it all comes together and you do show that value, like it can be really wonderful. But I would say, like, by and large, like a lot of founders are kind of in this current mode of an economic transaction that's happening. And so they may not always be open to it. And I think you also have to be kind of open to that.
Lisa, you had your hand up earlier.
I did. I think that we've kind of been talking about it, but I guess if I were to just ask the question kind of simplistically, this being my first time through, we've talked about there are different ways and people to get funding depending upon, where their trajectory is, where they are in their development. Is there a way you would describe the maturity of an organization or a company or a founder that fits this angel investing model, as opposed to some other mechanism they could use for funding? Like, how far or not far does one, or is there such a range that it's kind of hard to characterize?
The underlying component is you have to be able to look at the company and have a belief that it can get to be so big that it gives you 10 to 20 to 30x return on your investment. That's the fundamental part of equity-based growth company investing. And if you can't, if it's a coffee shop and you can't see how they're going to make 1,000 coffee shops, then you can't get there. There are pathways, which are angel quality returns, that are not equity-based things, where you can go another way. And we would use those in what I would call a local economy angel investor conference, but that's not typically what we're attracting with our current motion. And so I'll just say that it exists. And if you want to know more, we can talk about how to do that. And there's some books to read. But the thing that makes an angel investment work is that there's a new market, and that new market adopts this new thing, and that adoption curve creates that exponential growth thing. And if you as an investor cannot see that they have exponential growth, so for me, for example, I think that your company is at product market fit when you have revenue, you have exponential growth in revenue, and you have a bounded cost of customer acquisition. And if you can't answer me those 3 questions, then no matter how much everybody loves what you're doing, you're not a product market fit, because you have not had that audience start adopting you, right? And so it's the adoption curve that drives the exponentiality. And that's essentially what we're looking for. Now, you can get exponentiality in a small market and produce a lovely $10 million business, or you can get exponentiality in a big market and produce a $10 billion business. And so that's part of our discernment of how big of a company do we think that this group is going to be able to get themselves to.
Yep. And
That's
I should
helpful.
also,
Thank you.
And I would add, as an angel, again, this group is probably oriented towards, as John said, those venture scale and these companies that are reaching large markets. But as an angel, you could also be the person who invests in like local businesses. And, for our portfolio, we have our sort of tech investments that we have, that we expect to have a certain kind of model and growth trajectory. And we also made a couple investments in local businesses, and we track those in a separate area. So I sort of am like, oh, you can do both. And like, I think, again, you track them a little bit differently because the vehicles you invest with are different. The type of, I'm not banking on them having an exit or an acquisition. It's like usually it's like get to breaking even in sort of their revenue model, and then they're sort of we actually get more like dividend based sort of return. So I think that's it's worth considering in terms of like what is it that you want from this. And for us, one of those investments, I was like, oh, I like this founder. I think he's going to do great things. And we also were like, neither of us were working regular jobs. And I was like, hey, a little bit of like kind of income, not bad, right? And so you can think about it that way as well.
So Moo wants to know how you determine the value of a company with no revenue.
We invested, so of 22 companies, we probably have 18 had some revenue, but I say that some revenue with like, sometimes companies have the wrong type of revenue, right? Like there was a company that that went through Seattle Angel Conference when Minda was leading the round that was transitioning, and we see this a lot. They were transitioning from services-based revenue into a product-based revenue, right? And so yes, they have revenue, but it's like very different than the scalable product-based revenue that makes a venture scale. And so, what are the signals of transformation that is happening? In that company's case, it was actually when it's one of those things where it's like, can you start to get customers using the product and not calling you, right? That's the first signal of a product actually potentially being the thing versus like your service, right? And so that's kind of one of those signals that I might use to determine, hey, like, what are the assumptions baked into that services to product transformation, and how believable is that? You're suddenly saying, actually, we're like 80-20 now, and like by month 5, we're going to be like flipped. And yet like everyone, most of my calendar is filled up with like service calls. Like that's an assumption that is like highly suspect, right? And so I think those are the types of things I look for, is like what you look at their financial forecast, know that it is untrue, but you want to understand the assumptions baked in at every point, and what are the, what assumptions have been validated. I was talking to a company today, really fantastic founder, and he has made an assumption that in 12 months, he will be at 500K ARR with 16 companies, which roughly, or with a certain, I think it was about 16, which was like, okay, that means that you are going from zero spend on your business today to a product that people are spending $2,000 a month for. Like that is like a significant jump. So I asked him, how do you, like, what is that growth path? And what I heard was, I would say, like, highly unsatisfactory. So, think about sort of I would look at those assumptions and think about like, what is this a number that's actually grounded in some reality or some sort of like real experience that the founder has?
So the process.
So John,
yeah, go ahead.
Go ahead. I was going to say we are at time, so I'm assuming we'll be wrapping up soon.
We are, yes. So the process of understanding both the failure and the revenue and all of this is a lot of hand waving. And one of the people that had a good conversation was Hall Martin at 10 Capital out of Austin. Basically starts with $4 million, and it's $1 million per topic, right? The team, the market, the money, the management, and they try to go through and figure out, whether this product is good, where is it on the scale of really great to not good. And if it's really great, you put in $1 million. If it's half good, then it's, $500,000. And that's where it gets to the starting point of his conversation about the valuation of this investment. But let me say that as a lean startup fanatic, I think that people that are doing customer discovery need to get money from their customers very, very early, And so we shouldn't be doing any companies that are pre-revenue because they should have revenue from their customer discovery experiments. And if you can't find that at some level, then that's a problem. No, unfortunately, the market as a whole, 99% of the companies coming into what Yoko sees and what I see have no clue what lean startup means. And so they're not doing their customer discovery experiments. And so what I just said doesn't matter. But ideally, people are doing customer discovery. They're getting paying customers standing in line, telling them, damn it, build this product because I need it now. And that line of people is the traction that you need to build a product when the product isn't in the MVP stage, right? You need the market demand part. So I appreciate everyone asking questions. Those were good questions. I really appreciate Yoko and all of the support that we get from Yoko. You're teaching at UW still?
I am.
So if people want to do this formally and get credit for it, they can go to UW and take classes from Yoko. Yoko also has some events that she runs that are good conversations.
Yep, I'm just dropping
startups,
them. No, deals and drinks. But you
Deals and
could come with a lot of people come with water. Sometimes people show up with really fancy cocktails, and that's always fun. But yeah, feel free to drop us a line if you have questions. I'm really excited for you to start, especially, folks like Vinay, like I'm excited for you to start going from like the theoretical to like actually looking at deals and diving into them a little bit more, because I think that that's where the fun begins. So yeah, hopefully you'll enjoy the process. You're certainly in good hands with Kristan and John.
Cool. Thanks so very much, everyone. We'll see you next week at our How to Get the Most Out of SAC conversation.
Bye.
Thank you. Bye.